Well, good morning, everyone. Welcome to the video edition of Traders Espresso for Monday, February 26th, 2018. And it looks like the bullish buying that closed Friday is going to continue into Monday. At this hour, the futures are all up anywhere between 0.2% and about a little over 0.5%. The mini Dow futures are leading the way. The Russell futures are trailing. Um, Asian indices, excuse me, overnight were up across the board. European indices are up at this hour. Um, as I mentioned in the Traders Espresso weekend edition, here's the things that you want to look at. So looking at the Dow, which right now appears to be the strongest amongst the futures, if the cash market follows suit, it's going to break above this 61.8 retracement. So the key will be, will it close above that? Because if it closes above that, then I would expect it to easily blow through the 73.6 and go all the way up to retake these highs. Okay, the NASDAQ futures, so this would be the NASDAQ 100 and the NASDAQ Composite are both already above that 61.8% retracement. So for them, it's really just a matter of retaking the high of, not the futures, the NDX, if the, bear with me, folks. The NDX is already above this retracement. In fact, it's already above the 73.6. So it's really just a question of, this is a pretty minor move for it to head up to, 7,023. That should not be a problem over the next, couple days this week. That's assuming that everything stays as bullish as we've seen it. The S&P is just a little bit above that 61.8, so it's going to stay above it. So we're going to be watching it, I would think, travel up to 28.73. And the Russell, which right now seems to be the weakest of the indices, is right at that 50-day moving average. Today's action should break above it. So if it closes above that moving average, if it closes above the 61.8% retracement, which it's already at right now, then also we would anticipate that it is going to be heading up towards its previous high of 16.15 and change. Now, having said that, I mentioned in the weekend edition, video edition, so if you didn't watch it, check it out, because sometimes there's additional information in the video edition that's not in the written edition because it's very visual. I went through the put-call ratios for the ETFs that track the major indices. And I'm not going to rehash this again, but basically, if you believe the put-call ratios, the long-term prognosis for indices is bearish. The Russell, which is the IWM, that's the ETF that tracks the Russell 2000, was the most bearish at a put-call ratio of about 2.5. So what that means is that there are 2.5 times as many people transacting puts as transacting calls. And that is considered very bearish because buying puts is a bearish bet on the market. You're protecting yourself against a drop in price. Buying calls would be, pure buying of calls would be a bullish prognosis or view of the market. Let's take a look at the SPX and one of my favorite indicators, which is the stochastics and the stochastic histogram. And what we're seeing today is not necessarily inconsistent with what my long-term view is. My long-term view is that we are in probably the last throes of a bull market. I think that we're in the late cycle, the late part of an economic expansion. The thing is that bull markets don't just end overnight. They take a while, and you are going to have some bullish days. You're going to hit some new highs. That doesn't mean that the market can't go down from there. It just means that bulls are refusing to give up, but gradually losing steam. So for the market to go up is not inconsistent with a look at the day chart. The day chart is very bullish. We're seeing improving stochastic histogram. The week tells a little bit more of a muddled story because this is a bearish, look, but it has a little bit of a bullish tilt. So yeah, prices can go up, but the monthly chart tells us that this bar right here, keep in mind these bars on this chart are for the month. So every time a new month starts, a new bar is formed. This is February. We've got today, tomorrow, and Wednesday, and that bar will be complete. So unless we see just a massive rally, which is possible, unless we see just a massive rally, this bar, I think, is going to close to the downside. It's going to indicate a bearish stochastic crossover. And even if it doesn't, it's going to be right on the line. And all we're doing is we're deferring the pain. So instead, the March bar will be the bearish stochastic crossover. Doesn't mean that we can't see a reversal. We very well could. I'm just telling you what I think the odds favor. And the odds favor a correction at some point in time. The monthly stochastic has been oversold for almost a year now. If we expand this, and here's the other thing to consider also, and focusing specifically on the Dow, it's a different story with the Nasdaq and the Russell. It is a very similar story with the S&P, however, that we are going to see very realistically our first down month since April of this last year. And in fact, I'm not even sure if that's right. If I look at this, because if we take a look at these, this was higher, this was higher, this was higher, this was higher, this was higher than the previous month. So every bar was higher than the previous month, with the exception of April. And it's kind of hard to tell because the open, or rather the close for February was 23.63.64. The open for March was 23.80. So it was slightly up. Open was 23.80, so it was slightly up. So really what that means is we have not seen a down month in the Dow, or this is the S&P I'm looking at. We have not seen a down month in the S&P since October of 2016, since just before Trump was elected. In the Dow Jones Industrial Average, like I said, it's a very similar story. We are faced with the prospect, actually in the Dow, this is where I was getting tripped up, we're faced with the prospect of seeing our first down month in the Dow since March of 2017. So the S&P has the longest winning streak that's about to get snapped. The Dow is second place. The Nasdaq, I believe, is third place, and the Russell is fourth place. The Russell is the index that has the most recent down month that we've seen. I think it's absolutely significant, though. I mean, pay attention to that S&P. It would take a very bullish rally for February to close higher than January. I mean, we're talking a move of about a move of about 50 points. So if the close, if we're currently sitting at this 27.47, we would have to be above 26.83. No, I'm sorry. We'd have to be above 28.23. So from 27.47 to 28.23, that's about 50 points. Not to say it's not doable, because it's certainly doable. But instead of speculating, we'll just see what happens on Thursday, on March 1st. In other markets, bond yields are shying off of the 2.9. The dollar index is down. It is down at this hour. Well, it's flat. It's down 3 bips, 0.03%. So that is off of the lows of the morning. The index for the 10-year Treasury yield's about the same. It was down 1%. It's indicating 2.842. So it's shying away from that 2.9% level, shying away from that 3% level. That 3% level is the level at which a lot of folks will be calling for just being really disruptive to the equities market. There's some controversy on that. Some say 3.5, some say 4. I don't know. I've not really done the math on it to really believe one way or the other. Metals are up. Energies were up earlier in the morning, but then crude and heating oil took a turn. If I look at the futures, the crude futures are down 0.25%, so that's probably still the case. Nat gas was up. Nat gas is looking pretty bullish. It's been looking bullish last week. It's looking bullish this week as well. Mario Draghi started speaking about 8 minutes ago. Euro traders are going to be listening to his remarks to see if he's coming off at all of his very dovish stance. In past statements, he has mentioned that the European Central Bank will take a very gradual approach to unwinding the balance sheet, which is, probably unwinding quantitative easing, which would probably mean unwinding the balance sheet first and then interest rate increases. Overall, the ECB seems to be taking a much more dovish stance than the Fed has been of late, which would make sense because the recovery of Europe is about 6 to 12 months out of phase or the expansion of Europe is about 6 to 12 months out of phase compared to the United States, maybe even as much as 18 months. The pound is also up today. Jeremy Corbyn overnight, for us, made some comments probably about 11 a.m. London time, made some comments about, favoring keeping some sort of a customs union even after the United Kingdom exits from the European Union, and some moderate Tory voices, conservative voices, have come out kind of in support of that, which deals a little bit of a blow to Theresa May and her cabinet, their stance for a hard Brexit. The pound is up because a hard Brexit is viewed as very disruptive to the UK economy, and if Theresa May is going to have to capitulate in the face of this, kind of right now mild opposition, that would be good for the European Union. That would be, or not European. That would be good for the UK. It would be good for the EU too, but also be good for the pound. So that's kind of where things sit right now. It'll be an interesting day today. The tilt looks like it's definitely to the upside. Having said that, I wouldn't be surprised. I mean, we have seen days where it was up in the morning and we saw a fade in the afternoon. So just, be prepared for anything because there's a lot of mixed signals. There's a lot of back and forth, which, as I've said earlier in this video, is symptomatic of a transition, is symptomatic of a bear market that is about to turn bullish, or in our case, a bullish market that is faced with the prospect of turning bearish. So happy trading, folks, and have a great day. I'll see you on the other side of the live stream.